Thank you very much, Mr. MC. Assalamualaikum warahmatullahi wabarakatuh, and a very good afternoon, ladies and gentlemen. Thank you for staying with us in this conference. I'm sure we have had very good discussions in the morning, and I believe we will have some more very good discussion this afternoon together with our fellow panelists. Today's discussion is in regards to risk management in banks in the new era. But before we go into the subject, let me just say I am a moderator, and therefore I shall not be speaking anything about the topic if you ask me the question. I will put the questions that you pose to any one of the panelists. Only if they cannot answer, I might consider to chip in a thought or two. Let me then introduce to you the speakers. I have on my right Dr. Chong Hwee. He is a partner in the Financial Advisory Services practice of Ernst & Young Advisory Services in Berhad. He is going to be discussing on the aspect of financial risks in general, and in specific, but if he wants to touch on other things, I will leave it to you. On my rightmost left is Mr. Shan Saeed, my friend. You know him. He is Economist extraordinaire. Right? I don't need to say more than that. And on his left is Mr. Michael Sprake. He is a director in PwC Consulting Associates. He will touch on everything other than financial risks, most likely operational risks. Shan will be talking on geopolitical risks and anything else he wants to touch on. All right. With that, ladies and gentlemen, let me call the first speaker, Shan Saeed, to give his 2 cents worth.
Good afternoon. Assalamu alaikum, ladies and gentlemen. After lunch, I feel a bit lazy. So I thought, I should stand and speak. Geopolitical risk. How many banks have made the right call in the last 10 years? In the morning, I shared and we had a very nice discourse. And we ended up in one word that was trust. I feel that in the last 10 years, banks have lost their trust. And the reason is they are not engaging with clients. And how do you build trust? You build trust with good relationship. And how do you build good relationship? By giving good service. Service is the only differentiator among banks. And banks have been lacking in this area. Last 10 years, banks have paid $357 billion. Lately, 10th April, you pick up Financial Times, $1 billion by Standard Chartered Bank. I used to work. When this crisis started in 2008, UBS and Credit Suisse were penalized because 5,000 Americans laundered or tax evaded $1.9 trillion. So the regulators, they penalized UBS and Credit Suisse. Lately, UBS paid $4.2 billion to French regulators. And lately, you must have heard of a bank in Denmark and Sweden involved in money laundering linked to Estonia. So why geopolitical risk has become so important? 14th June 2016, we were invited by EPF. As you know, I work for one of the top brokerage firms. We don't have any banking license, no asset license. But we were invited just on the basis of our credibility. I'm glad in the last 4 or 5 years, people have started talking about credibility. And Badlisyah and I, we were having a very nice, deliberation on, whether you are obsessed with credibility or reputation. Reputation is what others think and talk about me. That is none of my business. Credibility means being honest, being straightforward, being transparent with your clients, and how well your clients have leveraged from your expertise. And how many times you have made the right call and how many times you have made the wrong call. And you are confident enough to stand in public and say I was wrong. That is credibility. 14th June 2016, we were addressing the top brass of EPF. As you know, EPF is one of the top sovereign wealth funds in this part of the world. And he said Brexit will happen. And the gentleman, right, head of private equity, he was sitting right at the back. He said Donald Trump or Hillary Clinton. I said Donald Trump. He said, how did you get this information? Bloomberg? I said no. World Bank? No. I don't follow them. I use my networking from my school. I'm a Pakistani. I have my friends who have gone to Harvard, Stanford. I studied from Chicago. So I use my networking and I only trust my 5 friends. I don't trust anything from World Bank or IMF or rating agencies or any Western media channel. And I will give you the value of Western media channel, what happened last week. So in order to understand geopolitical risk, you have to gather market intelligence report. You cannot rely on one single source. So if you pick up the book of Muhammad Al-Aryan, he wrote this book, The Only Game in Town. And on page 172, he talks about that economies don't run on one single variable. In January this year, one of the Japanese banks said, Malaysia will have a terrible problem because of budget deficit. 2 weeks back, a Singaporean banker working for a Swiss bank said, Malaysia is scary. There is paralysis in the Malaysian government. Oil prices are going down. So he was confused. So when you share these Cinderella stories and James Bond stories, you become irrelevant for the market. So that's why in the last 3-4 years, I have been sharing in public, talking to my sophisticated and sagacious clients, don't follow Western media. Nobody gave any coverage to Belt and Road Second Summit. So the reason is very simple. People in the West, they don't understand Chinese culture. I went to a Catholic school. I have studied European culture and history, Chinese culture and history. So I know, little bit of history of different parts of the world. But if you ask any of these Western journalists, they have no idea. Because they are misfit in this part of the world because they don't understand culture, history and people. So in order to understand geopolitical risk, you have to go deep down. Understand the likes and dislikes of a nation. In order to understand the history, you have to understand geography. I threw my geography book when I was in class 8 and I told my mother, this subject is useless. And now it is all about geography. There are 124 states, I told you, the game is in straits. You must have heard of Strait of Gibraltar, but Strait of Gibraltar is irrelevant. Why? Because people from Morocco, they take the ship, they go to Spain, and they stay there illegally. Nothing happens in Strait of Gibraltar. The action is in Strait of Malacca, Strait of Hormuz, and the third one that is coming up is Bab al-Mandab. We were talking about Djibouti in January 2015. Wall Street Journal, 26 November 2015 was talking about Djibouti and Chinese investment. August 20th, 2016, full page Wall Street Journal talking about their fears and concerns about Chinese investment in Djibouti. So these Western media, they have been 3-4 quarters or at least 2 quarters behind us most of the time. So nowadays bankers and banks, they need to understand what is the implication of Brexit. We are talking about $1 trillion being leaving the UK market. Last year, Europe was in the driving seat. But now, who is in the driving seat? UK. Europe is fearing, that they won't be able to get 40 billion pounds from UK if they were to leave this divorce. So a lot of variables are at play, and I will come back to Muhammad Al-Aryan's. He was talking about markets, policies, geopolitical risk, non-state actors. You ask any Western journalist, do you know who are non-state actors? I am bet they don't know who are non-state actors. Economies don't run on just one single variable. Just because of oil prices were going down in January 2016, people said, oh, Petronas is going to collapse. Post Donald Trump, ringgit lost 6.4% of its value in November 2016. And on 30th November, Banama, the local government TV, called me and said, Shan, what is your analysis for ringgit in 2017? I said, Tanku Noor, you have so many Malaysian economists, why don't you ask them? She said, we want a foreigner's view. Because most of the time people think, oh, he's Malaysian, he will speak in favor. We said 410 and 430. And Western banks, American and European, they were talking about 480 and 580, and they said ringgit is going to crash in 2017. 31st December 2017, ringgit was trading at 4.04. It was not trading at 5.8. So a lot of people, when they share these Blondie sandwich, and James Bond stories, they become a laughing stock. Look at what happened to this banker in Singapore. The bank has asked him, please don't go to TV anymore. Everybody loves limelight. I have been coming on TV and press for the last 18 years. My late father was a journalist. But I have built my brand, Shan Saeed, on my own. I never used my father's name in Pakistan. Banks have been failed to read the market. They just follow the Western media. And they say, oh, so-and-so media said oil prices will touch $10. So-and-so bank said oil will collapse. They don't really understand what is the fair market value. One of my professors said, don't accept things on their face value. The challenge is, we read New York Times, we read Washington Post, Wall Street Journal, Financial Times, and we think everything that is written over there is absolutely 100% correct. Wrong. I was listening to someone, he was talking about Belt and Road, and the source at the end was CIA, defense industry, and some other World Bank or IMF. I asked that gentleman boss, who is running Belt and Road? Is it China or US or Europe? He said China. So I said, why are you quoting US defense industry? It is just like somebody's asking about my house information and he lives 10 blocks away from my house. You're asking World Bank and IMF, they have zero contribution in Belt and Road. And what happened last week? Belt and Road, if you are invited, you are relevant. If you are not invited, you are irrelevant. In 2017, Singapore was not invited. This year, Singapore was invited because China wants Singapore to internationalize Chinese yuan. So at times, the bankers, they take it too easily, all these things. And they don't use their own discount rate. In geopolitics, you have to use a lot of things. You have to understand how the plays are moving. Who is calling the shots? I was in Dubai attending Financial Times event and I took an interview with CNBC. I said OPEC is relevant. And who is calling the shots in OPEC? It is Russia and Saudi Arabia. Last night, Saudi Arabia said we will be investing $300 billion in petro yuan. This news is not reported in Wall Street or Financial Times or Washington Post or New York Times. I only follow Economist magazine because my Nobel laureate professors would follow Economist magazine. I don't follow anything from rating agencies, irrelevant. World Bank, irrelevant. IMF, Asian Development Bank, irrelevant. I use my networking. So a lot of times you have to gather information from various sources. You can't rely on one single subject. You have to create scenario analysis. You have to use human psychology, market behavior, economics, finance, investments, and most importantly, statistics. Statistics should be backed by solid figures. It is not like Malaysian government is having paralysis. Malaysia is scary. When you make these comments, it shows that you have got childish attitude and immature thoughts. And your bank have not invested heavily in understanding and opening your mindset. So my message, or the bankers who are sitting over here, many a times you can make a sweeping statement. You can create a mountains out of molehill. but then you become irrelevant. And in the last 10 years, many banks have become relevant. You say Morgan Stanley, irrelevant. The only American bank right now which is relevant is JP Morgan. That is doing the right things. You look at French bank, BNP Paribas, Societe Generale, always on the dot. British banks, irrelevant. I wrote on my Twitter account on 24th February 2016, messaging my sister who is living in London, stay away from American and European banks. And look at what is happening with these banks. They have paid heavy penalty. Name a single Asian bank that is involved in paying more than $10 billion in penalty. You look at all these Western banks, they have paid penalty. Why? Money laundering, compliance process. Central banks have fined them. LIBOR scandal, FIFA scandal. Who did it? Michael Platini was not born in Cambodia or Laos. Michael Platini was born in France. The biggest challenge right now in Europe is corruption. Nobody's talking about it. If you pick up Rand Corporation, that is a think tank in Europe, the combined corruption in Europe stands at $1.2 trillion, which is roughly the 6% of European GDP size. But they always talk about Asian corruption. When you start talking about European corruption, they become defensive. And they say, no, we are angels. So a lot of times, you see, you have to look at variables from various sources. You have to look at the players' movement. Who is calling the shots in sovereign wealth fund? Who is making the movement in central banks? Central banks till last year, everybody was saying the interest rates would go up. Suddenly Donald Trump came. He is from the real estate market. He said interest rate has to go low. Larry Kudlow said interest rate will be down by September. Who is Larry Kudlow? He used to work for Reagan administration in 80s. Now he's in 60s and 70s, old man. He can't really think. But they are giving the dictation. The central bank independency in US is gone. It is the Trump's Fed. Because out of 7, he has to choose 5 members. One of my professors at University of Chicago, Randall Kuzner, used to work. He left in 2009. Janet Yellen, when she was the Fed chairman, Economist magazine, there was a title called Funny Numbers. 24th October 2015, page 66. The markets don't believe what Janet Yellen is saying. Because Janet Yellen was pure academic. She was not pragmatic. She was not on the ground. So a lot of time people think, oh, Jay Powell has said this. Okay, this will happen. You can't accept things on the face value. Janet Yellen said on 27th June 2017 on Fox TV, we will not have financial crisis in a lifetime. Can I say that it will not rain for the next 1 week in KL? You will say, Shan, are you on drugs or you are mentally retarded? On 27th June, Fox News, Janet Yellen said, we will not see financial crisis in our lifetime. What happened on 20th November last year? FANG stocks lost $957 billion in less than 3 hours. Investors lost $5 billion in equity market in US in the month of October alone. And Janet Yellen said, we will not have financial crisis in a lifetime. So a lot of times, what I've learned from my professors, I attended World Bank IMF meeting. I didn't get excited because I found people over there, they were not as smart as I thought, people working for World Bank and IMF. It's very ordinary. It's very bureaucratic. So a lot of time we get carried away, with various brand names, and we think that, XYZ bankers coming from the first world countries, they're very smart. Absolutely wrong notion. Use your own discount rate, study hard, get market intelligence report, and you should be fine. Thank you very much.
Thank you very much, Shan, for the brilliant description of what you need to do to understand geopolitics. Trust your own people. Don't trust the Western journalists and medias. Know the players so that you can get the information from the horse's mouth rather than from somebody who is sitting on a desk somewhere in a small room in New York. Right? So at the end of the day, many of us probably have experience in engaging with those experts to get a feel of the market. I, at one point in my career, as a political risk institution, they give political risk assessment on various countries, and I asked why Malaysia was high risk at that point of time in 1996, 97, and the response given was, you have passed an Islamic political party. We have never had any political instability in this country since independence, and somehow or other you have a Western institution that do an assessment of our political risk and tells the whole world that uses their assessment that Malaysia has a high risk. Right? So at the end of the day, we must do our homework, as Shan has said. With that, ladies and gentlemen, I would call on Dr. Chong to give his 2 cents worth.
Thank you, Dato. I thought I'd stand up as well.
Yeah. It keeps you healthy.
Good afternoon, everyone. When I was asked to present on risk management, and that's the first thing I'm thinking, like, what really is that interesting about risk management? I mean, to me, yes, because I practiced risk management for pretty much my entire professional life. But I would like to bring everyone to a bit more specific items on risk management at the backdrop of what's important in risk management in terms of sustainable growth, in terms of how do we then help becoming a business partner to the business, and therefore achieve the return on equities. So there's a few things that I would like to touch on today, revolving around 3 key takeaways. So the first one is really risk management. It is a key, and it is enable the business to transform and sustain growth. Because without growth, obviously, we won't be here. Second point is on technology. I think I can't go without talking at the banking summit, especially banking 4.0 earlier on, without touching on data, without touching on technologies. So I think that there is really room for risk management to accelerate their adoption of new technology. And lastly, risk management as a line 2 of defense can only do so much. I think the practice needs to be institutionalized at the day-to-day activities, and how then the first line of defense can then manage them a bit more effectively. So with these 3 key takeaways, I would like to share a few things on the recent trends. So what we have saw in our recent survey in the late 2018. So I'll go through a few slides on that. And the other 4 topics is on new customer acquisition, because I would like to talk about how do we sustain growth, how do we then achieve our ROE basing on the revenue stories. The second point is on managing existing customers. Now, there's many ways of managing existing customers. I would really like to touch on collection, because I think in terms of analytics, collection, there is still a fair bit of room for them to play. And the fourth point is really about automation. I think, again, I cannot go without talking about robotics, talking about AI in terms of risk management. And lastly, with the introduction of IFRS 9 recently, I think the forward-looking element is also a key thing for our business to look into, and how that risk management is linked to that. So those are the five areas that I'll touch on. So let me first go through the survey done by EY as well as the International Financial Institution. So this survey is conducted late in 2018, and we have 74 banks globally representing 29 countries that provide this few stats. So the first slides I would like to talk about is, what are the top factors driving your ROE in banks? So these are the survey results, and the first question is what target are we looking at? I think 11 to 15% is rather straightforward. I think is rather reasonable in Malaysia perspective. But more so, if you look at banks that is targeting at 11% or more, actually almost 80% of them are targeting at that. Yeah. And if you look at the changes between 2017 and 2018, those that target at 11% or more, we have increased from to 5% increment from 17 to 18. So what really does tell us is there is a huge pressure on ROE. I don't think this is new. I think this is on year basis. When come budgeting, everyone is talking about ROE. Now, how is this then look at risk management? How can risk management play in a role? So from the survey, we also know that we asked our top banks across the world, what are the top 3 factors in achieving your ROE target? And I think all these are also not very new to us. We can almost guess, and I'm sure that you guess it right. The first one is how do we able to grow our revenue? Right, 68% of the respondents says that's are the top 3 factors. And what about operating cost? How do we reduce cost? I think this is straightforward, right? 1 plus 1 equals 2. So if you need to grow the 2, you need to either increase the 1 or reduce the 1. And then the ability to implement new technology is also almost half the respondents is stating that is the top 3, and macroeconomic factors. Right, I think the last point, almost everyone is talking about macroeconomic factors. How is, say, oil price? If oil price goes up, Malaysia's economy is going up. Yes, but there's also another element to it, which I'm going to touch on a bit later on. Okay, so what is our revenue stories? Right, revenue can come from many different angles, your services, your products, but I would like to touch on more on the new customer acquisition, and in specific, the unbanked population as a growth of source of growth. So that's the first point. The second point is, what is the ability to reduce operational cost? And I like to look at it on a collection strategy perspective. So how collection strategy can reduce your cost? I think I won't touch on it now, but let me go through the detailed slides with you a bit later. And in terms of automation in managing risks, I think in this era, with the cost-conscious economy, banking industry, how do we then increase our productivity if we are bogged down with a mundane operational task? So how can technology help in managing risks? And lastly, on the macroeconomic environment, as mentioned earlier, oil price, yes, there's general impact to the economy, but I would like to bring everyone to the topic of provision. So how can provision then be managed, and how provision then can help you in terms of looking forward in crafting out your business strategy. All right, quickly, why are we looking at revenue and revenue growth in terms of the new customers? Because as mentioned earlier in the talk before lunch, we talk a lot about fintech, right? New entrants to the industry, that the bank is facing a lot of competition. But we have not touched on those that has been unbanked customers, generally individual that has not been banked at their younger age, as well as the SME that's not with the bank at this stage. So is that a big market? I'll show you some stats later on. I think to me it is a big market where bank can target on. Ability to reduce operational cost. Better collection strategy enables cost savings. I think in terms of cost, if you talk about collection is something that, when you make a call, and that's a cost. Right? When you make a call and could not talk to the right guy, is also a cost. And you make a call, you talk to the right guy, but the right guy not responding, is also another cost. Now, how analytics can help in reducing that cost? Right? I'll talk a little bit more on that. And technologies, all I'm touching on technologies here today is very specific, is to take away those operational activities so that the existing resources that you have is able to focus on more value-added tasks. I think this is not new in terms of why we use robotic or AI. And lastly is managing volatility in provision, which has a direct impact on your P&L. Right. So quickly, in the next 4 slides, let me introduce you a little bit more stats in terms of the survey results. So the first one is, what role should risk management play in enabling business growth? So the key is to provide faster and more accurate risk decisions. And that really sticks out. Now, we also know that from B&M recent report in 2018 on financial stability and payment system, that apparently there is 8% of adult population in Malaysia that is unbanked, and of which 64% are between the age of 15 to 24. Right. And we also know that 77% of SME are micro enterprises, and only 22% had financing with FIs. Now, with this SME, I think focusing on SME is not a new thing in Malaysia. But the unbanked individuals, now how do we traditionally acquire new customers? So bank, typically in risk management practice, you will have your application scorecard. Now, application scorecard is nothing much but your static information. So, for example, I'm going to score your income level. If you are earning 5,000 or above, you get a certain score. If you're a certain professional, you get a certain score. So all those information are very static. Right. Now, if you think about those 15 to 24, age 15 to 24, their score cannot be high. Right. And you think about, if their score cannot be high, if they don't get above the cutoff rate, they won't be able to get a loan or a facility with the bank. Now, how is bank dealing with this? I think in the last couple of years, in the banking industry or risk management, there's a lot of talking about big data. Now, what is big data? We know that bank has a lot of data. Right? Are those data sufficient for you to analyze whether this unbanked individual, is it worthy to bring them into book? I'm not too sure, because they have what they have, right? If the information that they have for application is in fact, my first year of developing an application scorecard maybe 15, 20 years ago is not much change. Not much has changed since then. But we're still talking about big data. So to me, in terms of big data for all these customers is what I call unstructured information. Information coming from social medias, for example, as a source of additional information. I'm not saying that traditionally those information you use in your application scorecard is no longer applicable. No, I think that serves as a base. But if you have additional information from those unstructured data perspective, then that adds to the information that you have, and you're able to assess that. But the challenge is obviously your PDPA is a challenge. So how can I access to your personal information, right? And more recently, I think the bank is also talking about open API. I think that's a good start in terms of sharing information across. But until then, I think this remains a challenge in terms of data. How do we, from unstructured, make it a useful information for the bank? And second is, how do we then manage within the regulations as well? Now, the other part is also on machine learnings. And I'm quite sure that in Malaysia, in terms of risk management models, machine learning has not been applied. There's a couple of challenges in terms of machine learnings, because machine learnings unlike fintech, right? If you look at banking in general, if you want to develop a model, say an application model, it'll probably take you, say, a month or two, and post that, you probably test it for a month, and post-testing, you probably implement it. And implementation is going to take another 3 months. So if you look at end-to-end process of 6 months at the minimum, how is machine learning can help? I don't think so. It can help from that perspective because the governance from a bank it still needs to be there. You cannot simply implement a new model because that's got a different implication to your business. But what machine learning can do is to provide you with, say, a new model rather quickly, but that serve as a challenger models. So for you to compare to those that you have implemented. Now, until such that your challenger model become a much better model than your existing model, potentially you can swap them, right? I heard the bell. I'm not sure how long I have. 2 more minutes. I thought I'm going to talk for 5. All right. Quickly touching on managing risk, on adapting and managing portfolios. So credit risk analysis and modeling, as mentioned, that has always been the top 2 areas that affecting because of the use of new technology. So why am I choosing from a collection perspective? Because collection can serve two ways. One is to prevent, and the other one is to remediate. And if people that is closer to IFRS 9, as you know that if you prevent them from moving into your bucket 2, bear with me if you're not familiar with IFRS 9. So with bucket 2, you go with your lifetime PD, lifetime LGD, lifetime EAD, which then makes your provision a lot higher. Now with prevention of going into that, obviously, you will be using only a 12 months PD, 12 months LGD, 12 months EAD, and therefore the end result is still a very much lower provision. Now remediation. So with the same token, if I take IFRS 9 for just an example, you are looking at bringing them out of bucket 2. So bringing them out from lifetime provision perspective to a 12 months provision. I think that itself is a lot of savings, and that, as you know, it will impact your P&L rather directly. The third point is on automation. Again, I won't touch on this that much because in terms of automation, to me, in risk management practice, it's all about getting rid of those processes that you need to do on a periodical basis. So it can be in terms of monitoring, in terms of even for modeling perspective. All those are rather process driven. So you can automate certain processes so to allow your resources to free up to interpret the results. Because often when we review a bank, we often see that the problem with the bank is not like they don't know how to do, but they are just too much into doing and not doing enough on interpretation of the results, right? So they are pretty much just keep on churning and not interpreting. And on the last point is on provision. Why is it so important? Is like I mentioned earlier, macroeconomics. I think in terms of oil price, whether oil price go up or come down, we know that it's going to impact Malaysian economy. But not just that. As an individual bank with the introduction of IFRS 9, that will also means that your forecasted provision is going to go up or coming down. Now, if you know that your forecasted is going up or coming down, now who should you book into your book? Because provision nowadays is no longer on incurred basis, it's on expected basis, and therefore from day one perspective, you will already be providing for them, even though they are just day one in your book. So with that, I think I would like to spend a bit more time on our discussion later, then continue on wobbling about all these different topics. Thanks.
Thank you, Dr. Chong. First of all, thank you very much for putting sexy back into risk management. Nothing more sexy than ROE, right? We don't do risk management because we want to comply with things. We don't do risk management because of anything other than, well, I'm exaggerating a little bit, anything other than maximizing return on equity for the institution that we serve. At the end of the day, if we lose focus of that ROE, we may do the wrong thing. We may be advising the organization to do things that are detrimental to the organization. Right? It is. There's always a debate between nice to have in terms of risk management. I want to be the best in managing all my risks, but we might just overdo it. Right? We might impose certain processes or impose certain rules that are not needed, actually, for the purpose of the organization. I think, thank you very much for putting that perspective to the conference today. With that, last but not least, I shall invite Michael to give his peace of mind on the subject.
Thank you very much, Dato. Good afternoon. I see some sleepy faces. I will be as punchy and as loud as I can. To start with, Shan, I have never been a Western journalist, and I am not a Western journalist. Can I just confirm that? I do have views on Brexit, being from the UK, but I don't intend to share them in a public forum. So thank you. This will be short and sweet. Forgive me, I am going to have to make reference to some of the comments I've made. There are three groups of individuals I believe are least excited about Bank 4.0. First and foremost are risk and compliance professionals in banks. Second are the regulators. And third are bank robbers, the old-fashioned type that go and, stick them up type thing. All three of those groups are a little bit concerned. I'll go on to tell you why. But let's look at risk and risk management as a whole. So, back in my motherland in 1760, when they invented the spinning jenny and the seed drill and all of these things, there were risks. There were risks that the steam engines that drove them would blow up. There were risks that their staff would steal their technology. Moving forward to the second industrial revolution, Henry Ford, electricity, mass manufacturing. Again, risks, operational risks, that the manufacturing line would break down, that the electricity wouldn't be provided. You move to the third industrial revolution, 1950s, 1960s, the advent of computers. Okay, the advent of computers, banks, we start getting interested. Because the first two industrial revolutions didn't really impact banks. The third one, computers, huge impact. The reason we have account numbers is the fact that computers need a number, a unique identifier to identify customers. They can't do it by names and names alone. And so we come to Industrial Revolution 4.0. So, is it going to bring lots of benefits? Undoubtedly. We've had some interesting discussion this morning. Fellow panelists have talked about some of the changes. But risk as a whole isn't new. I said, they've had it all along. For banks, it's in their blood. It really is. I've just got a selection here. Operational risk, the payments processes you have to undertake. In the AML world, the screening processes you have to undertake. Credit risk. The reason banks have been around for, certainly in Malaysia, I think Standard Chartered and HSBC have been here over 130 years, 135 years. Banks are pretty good at credit risk. Yeah? Credit risk, there's an element in there called judgment, by the way. And I'll come back to the theme of judgment. Because the whole thing around AI, machine learning, all of this, my personal view, there's always going to be the need for human judgment. That said, it will be more informed. Fraud risk. Okay, so checkbooks, a dying thing. Check fraud used to be the big issue. These days, fraud is far more sophisticated. Regulatory risk, physical risk. Physical risk around branches, around the bank robbers stealing money. That was a real issue. And likewise, regulatory risk. There have always been regulations. But I want to move it forward. So, let's look at today's risk landscape. And the point I want to make to you is, don't forget about that slide I've just shown you. That still all applies in a slightly different way, but it all applies. So what I'm saying is a double-edged sword. There are more and more complex risks that have to be considered by financial institutions. Nearly all of them are not financial risks. They are risks around governance. They are risks around data. They are risks around proprietary systems. Dr. Giovanni talked about how banks merge, they acquire other things, they end up with this checkered quilt of different systems that don't talk to each other. What they also find on the human capital issue is that there's one guy in the bank that knows how that system works. That guy then retires and the bank is left with a huge gap and a huge concentration risk. Sustainability risk. Dato's here from Islamic finance. VBI is an issue. There's a regulatory expectation. So value-based intermediation is a regulatory issue. Sustainability. Shan talks about credibility, reputation. I disagree with Shan. I think reputation is important. And I think if you have a reputation for being a sustainable institution, for having consideration to society, it matters. Credibility, I'm not discounting that, but I do genuinely believe that reputation matters. And if you guys all went back to your CEOs, or your CROs, your boards of directors, and asked them, does our reputation matter? Yes, it does. They want to be credible, but the reputation matters as well. Regulatory scrutiny. It is a growing list. It is growing day by day, week by week. It's something why, again, CROs, risk practitioners, compliance practitioners have a real fear because this list is just growing. And that has a knock-on effect to you in the front line or to those in the first line who have to supply the information to allow the regulatory reporting to take place. And number 5, data is the lifeblood of the modern world. I'm stating the obvious, but it is. It was the oil rush, now it's the data rush. There's lots of it. Banks generate so much of it. Do they know what to do with it? No. That is where Industrial Revolution 4.0 will have an impact. They will be able to come up with great new ways to use that, both from a growth perspective, but also I believe it will be a key player in helping banks manage their risk. So let me move on to a couple of key points. We face an evolving level of complexity in the number and type of risks to be managed. Organic identification of risks and a lack of horizon scanning result in reactive frameworks. Everybody's focused about top risks. The risk I can see at the moment. The risk I can see next month. The art, and this is where almost the bottom point on proactive analytics comes in, the art is to extend the horizon as far as seeing risk that is emerging. So that's 6 months to 12 months and beyond. It's very important, and particularly picking up on Shan's point around geopolitical risk. Geopolitical risk, rarely does it just happen overnight. There are signs, there are indicators, and if you're looking at the right sources, listening to the right people, having the right conversations, you should be able to have an element of predicting that this may occur. And when I say may, it's quite important because part of risk management is the what if. The other point, a push for greater agility in the workplace. The problem we have is that risk management frameworks are set in their ways. They are iterative in the sense that basically a new risk comes along and we just bolt it on to our existing framework. There's an Australian futurist called Brett King. I advise you, if you get a chance, listen or read Brett King. President Xi Jinping in China, he swears by him. Really worth it because he talks about this iterative iterative, or, and we heard it earlier from Chan Kok, first principles. Let me move on. Okay. This is about as digitization as I get. A PowerPoint slide that moves. Quite proud of that. Okay. This kind of points to the fact that some bits move, some bits don't, but it's a complex web. If you actually look within each of those separate cogs, there are smaller cogs, and that is the complexity of risk management. However, as you just saw, not all the cogs were spinning. The problem is, unless you have a strategy, and by this is where the first principles thing comes in. Think about this. I continue to just add risks and risk management into my existing framework, which is already struggling. I'm putting more and more pressure on that framework, and eventually it will fall over. If I take a step back and think about, can we do things differently? And again, I'll reference Brett King. He talks about Elon Musk and Steve Jobs. Two individuals, first principles. What did they do? They said, scrap this, we'll start from scratch. And that's a key question for you as an organization is my current risk management framework fit to enable managing risk in Industrial Revolution 4.0? If you have a clear strategy, and if my technology works, actually, it can all work. As opposed to little bits working here, little bits working there. This is about having a system where it all can work in harmony. And there is a huge role for technology to play in that. You look at this. You all have operations that are spread around. You all require returns to come from different places, different countries, particularly increased globalization. That can happen now. The cloud presents huge options for us to integrate and pull all the information we need into a single place where it can be analyzed using machine learning, using AI, to come up with informative and insightful commentary. So, my last slide. I told you it was going to be short. So, this is to get you to think about whether your existing framework has these components. If your existing framework has this, then it's about maximizing them. If you can't deliver this in your existing framework, it comes back to that first principles question. Do we need to start again from scratch? And I'm going to quickly just run through. First and foremost, a strategy that recognizes that risk is immediate, medium term, and long term. And a risk appetite statement that clearly understands and interprets the view of the organization. The second point, a culture that embeds risk management. I want to keep that and the next point together. Clear understanding of risk and control ownership. What many organizations fail to successfully communicate is who is responsible for the risk. In most instances, it is the first line of defense that is responsible. It's not compliance. Compliance is the second line. It's there to make sure adherence. But it is the first line that has ultimate responsibility. And that's key in terms of the culture to pushing that down. Processes and controls that leverage technology. That's where you need to look at the opportunities of Bank 4.0 and say which of those are important for my managing of risk. A lot of that is around analysis. It's capturing data, looking at risk maybe on a more customer basis. Is there a difference between a person employed as a consultant here in Malaysia and a consultant in Singapore in terms of a risk profile? I don't know. There might be in terms of a spending difference, but from a risk perspective, does it differ? It's a question to ask. Clear instructions and communications. That again sits with the whole thing. If you're going to introduce new management of risk, if you're going to ask people to look at risk from a different perspective, holistically, you need to communicate that. And the bottom two, again, I'll put them together. Management information that provides strategy and insight, and governance and testing, your third line of defense. That's it. Okay? Short and sweet. No bell.
Thank you, Michael. I think the key takeaways that I got from you, Michael, is that at the end of the day, if you want to prepare for the new era in terms of risk management, re-engineer, right? That's the gist of it, right? No patchwork. Just re-engineer the whole process so that you are ready to really do risk management under new challenges, new opportunities that exist within the market. I think, ladies and gentlemen, we are now at about 3:40. We end the session at 4, so you have a full 20 minutes to ask any burning questions that you may have to our panelists. As such, I shall open the floor now. Okay, no burning question.
No burning question, no childish question. I was just talking to Badlisyah. You can ask any burning question or any childhood question. When you were very young, you thought, one day I will go to KSI and I would ask a question from the panelists. So that is childhood question.
Anyway, since there's no questions, I shall ask the question. Shan, from a geopolitical risk perspective, how do you see Malaysia vis-a-vis ASEAN and China?
I moved from Chicago to KL 7.5 years back. And when I was moving, people said, don't go to Malaysia. It's a third world country. You will die. I said, nothing will happen. In the last 7.5 years, my analysis about Malaysia and what I think about Malaysian people, they are very productive, tech savvy. I have never been mugged. I have never been bothered in Malaysia. The people of Malaysia are very, very accommodating. The respect, the recognition, the love I have got from nobody to Shan Saeed. I'm just an ordinary person, just an ordinary foreigner. People like you and many others, I did not know Badlisyah when I came to Malaysia in December 2011. I did not know many people who are sitting over, some of my friends. Tansari Michael, I did not know. So, I used a very simple strategy. I did not have money. I used press for my advantage. I had the knowledge. I went to the local magazines, Smart Investor, Money Compass, Business Today. I said I have got expertise in the commodities market because I do romance with commodities. I said I do romance with financial markets. My article started getting published in Malaysia. I took the same article. One international media channel called Al Jazeera saw my article and said, Shan, please come and talk about Europe. That was January 2013. February 2013, Al Jazeera again called me. That's how I started building up my networking in Malaysia. Overall, I think the country, I will quote Michio Kaku, who is considered as an authority in science. He said, what I like about Malaysian people, he came in December 27, and I quote, people in Malaysia, they have got burning desire to succeed. There is one element missing, and that is sometimes the execution is not done professionally. Unquote. This is Michio Kaku, not Shan Saeed. Overall, I think in ASEAN region, after Singapore, I feel Malaysian people are much more productive. Why Malaysia is still relevant? Because of her geography. You can't change your geography. I often ask and joke with my Malaysian friends, can you change your geography? No, we don't want to live in Singapore. We want to live and we want to be next to Liechtenstein or Luxembourg. You can't change your geography. And I have been sharing that China will never leave Malaysia for the next 50 to 100 years because 80% of China's trade moved from west to east to Strait of Malacca. I was invited by Hong Leong Bank last January to speak to the institutional clients. I went to Malacca. I fell in love with Malacca. The food is so nice, people so friendly. So overall, I think Malaysia for global investors, I can share some information for you. After second summit, Belt and Road, Malacca is becoming the blockchain hub. Penang is becoming the manufacturing hub for Chinese companies. KL will become the AI hub. If you pick up any Western press or newspaper, they say, Huawei is a threat. Huawei is setting up its customer care center in Malaysia, Pakistan, Djibouti, and Russia. And the amount of investment that we are talking about, it is not 100 ringgit. It is not 100,000 ringgit. We are talking about 10 to 15 billion dollars of investment coming from Huawei alone. And the second thing that I can share with you, Huawei is coming up with 6G. Next year, Malaysia will be getting 5G along with Pakistan, Djibouti, and Russia. So these things, Western press will not tell you. They say, Malaysia. No. As Badlisyah said in 1996, Malaysia is a high-risk country because of PAS. And PAS, they're not very significant at that time, if I'm not mistaken. So, a lot of times, you have to look at the economy from the macro perspective. It is always the macro that drives the economy, not the micro. And who drives the economy? People of this country who are productive, who are efficient, who can speak not in Queen's English, but in proper English. How do you judge people whether they are civilized or not? I was talking to Tansari Michael Yo. My elders told me 25, 30 years back, the moment you step out of the airport, you judge whether the people are civilized or not. So for me, Malaysian people are very okay. There's nothing to worry. They don't bite, they don't eat. They give a lot of space to foreigners. Thank you.
All right, thank you, Shan. Opening again to the floor. All right. Then I'll turn to Dr. Chong. I think at the end of the day, people see, many organizations have this misperception that risk managers are an obstacle to business. They tell a lot of problems, you cannot do this, you cannot do that, right? How do you see risk managers within a financial institutions like a bank do their work as a partner to businesses to achieve the ROE that you mentioned earlier?
Let me start off with some of the historical background, right? I mean, in terms of CRO perspective, previously you don't have a CRO, you don't have a Chief Risk Officer. It's always either under finance, reporting to the CFO. So the prominence of risk management practice has so far evolved. And now you have a CRO as a designated chief. Now, that's just a title. But I think the evolvement is also included CRO into the management committee in discussion about business, no longer about just managing risks. So in terms of organization, I think we are pretty much there for quite some time. I think risk has a prominent role in terms of the senior management. And secondly is about, I think, to me, everything else needs to revolve around KPI. Right? If you set the KPI at the right direction for everyone, then everyone should move at the same direction. Now, if you set the KPI as like, your model cannot need to pass validation on a yearly basis and so on. So guess what? What they will be doing? They will just passing the validation as a top priority, right? Rather than how can I tweak? How can I change? Or how can I enhance my models to better help business to acquire? Or not so much to acquire, it's actually essentially to support the business strategy, right? So, for example, if I'm a credit card head, I want to be a bit more aggressive in growing my books. So, what should I do? Right? I could have just reduced my cutoff score, so more people can come in. Obviously, they will do their marketing stuff and so on. So those are the pure business perspective. But in terms of risk, now, I'm not just. I can assure you that once you reduce the score by 10%, you can increase your book by a certain percentage. But what does it mean to the business? You cannot just say I increased my book by 10%. But how much risk are you bringing in? Because if you are already aiming at the cream of the crop out there, and the remaining are, if I term them as second tier customers, if you bring in the second tier customers, how much of NPL is going to increase to your book? I think those are the element that needs to be analyzed, and needs to be analyzed between risk and between business. Together, only they will come up with the right strategy. Otherwise, business can say A, and as a risk manager, I could easily do that rather than analyze further. Right.
Thank you. We have one.
Yeah. Good afternoon, panel. I have one question this afternoon. Now, the whole morning, from the 3 or 4 panel discussions that we have gone through. Oh, by the way, my name is Han from Philip Bank that is based in Cambodia. So something new for me to think about, hearing from the Malaysian point of view about banking disruption. I'm Malaysian, by the way. So, like Michael, you talk about breaking banking 4.0, and talking about if the bank doesn't change, it will become like Nokia, like Kodak, it will disappear. And this is one school of thought. And this morning, the other school of thought from the panel speakers is that don't worry, bank will still be there. Bank will still be there because they are trusted, they are regulated. So 2 very different point of views that I so-called absorbed this morning, and which school of thought will be more relevant. And I'm thinking about if the bank were to continue to survive in the future, should we go using breaking as an example, you have to adopt AI, you have to adopt machine learning, deep learning, collaboration with fintech, change organization mindset, change culture change to adopt to the new fintech environment. And if the bank continue to be where we are today, will it die a natural death if we don't evolve? That's my question.
Right.
Thanks.
Thank you. Michael, you
want? It's a good question, because traditional banks are unwieldy oil tankers that take years to change. Having worked for HSBC for a number of years, it is a big bank in 60-odd countries. It's been around for 150 years. Change is challenging. That said, I think banks have recognized that this industrial revolution and the change, this integration between technology, the physical, biologicals, what is going on at the moment is unprecedented. And because of that, they do realize they need to do it. Now, they can do that in a number of ways. They can do that by being an early adopter and try and do it themselves. They can partner with fintech companies themselves. They can buy fintech companies. Indeed, some banks have done that. I think traditional banks will survive. They will take different routes through to the next stage of their development. And that will depend on where they're based, whether they will skip various things. And the only comparison I can draw is you look at landline telephones in Africa. Africa skipped landline telephones. It went straight to mobile. Why? Because it had learned we don't need it. And I think what you'll find is different banks in different jurisdictions will take different routes, but they will survive. That's my view.
Thank you. Please share.
The model that I used to work for Standard Chartered Bank, the model that I think the banks should be following is if you pick up Paul Krugman's article, long time back, 31st January 2010. The title of that article, if you have Google search, it's available on the internet, is called Boring is Good. And Paul Krugman, before getting his Nobel Prize, wrote and cited Canadian banking system. This is 2010, after the crisis of Bear Stearns and Lehman Brothers. and AIG was about to go for the funeral, and then JP Morgan and Goldman Sachs saved AIG. So he cited the Canadian banking system, and he talked about the toxic assets like derivatives. If you ask bankers about toxic assets, they will talk fancy. But what is derivative in a simple plain English? It is like, I am passing my risk to you. So I am covering myself. But if you ask a banker, he will come up with such a difficult philosophy and literature that you will get confused. He will get confused himself, and he will confuse his client. So I think banks should be boring. If you ever find a banker talking about fancy, stay away from that banker. I can quote you, I was in Dubai, December 2017. One of my good friends, he said, Shan, take position in Bitcoin. I said, boss, my brain is small. I only understand tangible things. Real estate, gold, silver, oil, I understand. Bitcoin to me is like a Ponzi scheme. Everything is in the air. Have you heard of Bernie Madoff? Bernie Madoff, have you heard of his name? He cheated $50 billion of Americans' money. And now he's in jail. And his name has been changed to Bernie Madoff. He made money of $50 billion and then he ran. Ponzi scheme. So the first time I learned about Ponzi scheme was after listening to Bernie Madoff. So go for tangible stuff, And banking should be boring. That is the ideal model. And it's there by Paul Krugman. Thanks.
Just rather quickly, I think in terms of change is definitely inevitable. I don't think anyone can disagree with me. And if you don't change, or the bank doesn't change then, or doesn't adopt new technologies, to die it off, not too sure. But then definitely, if you look at my chart on the ROE earlier, it probably will be at the bottom few than at the top. So if you're still driving at the ROE, I think change definitely needs to be there. My personal view for Malaysian banking sectors is to accelerate the adoption of technology. I think we do have a very good fundamentals. We do have a very good human capital. We do have the know-how, the technologies, and so on. But it really seems to me, to become a digital bank, we have been talking for a long time, and just taking off, it takes a long time for us to even just to move a step. But if you compare to our neighboring countries, they are moving really fast. I mean, I'm not talking about just Singapore, right? I'm talking about if you look at Vietnam in terms of human capital, in terms of the know-how, they are far more faster in catching up to us as in Malaysia. Cambodia is the same thing. I was there about 2 weeks ago, talking on a topic, and the question that coming from the ground is so relevant. So for me, I would really hope that Malaysian banking sectors can really accelerate that change and the technology adoption.
All right, thank you. I guess to conclude this particular discussion, banks should embrace change but stay boring. All right. Anyway, we have got another 2 minutes. I think I have one last question from the gentleman in front who wanted to raise his hand just now. Are you asking the question? Not asking the question.
It's slightly different from the topic, because so far we focused on banks and the revolution etc. How they start moving and transforming themselves in some ways. The question that I would like to ask you is slightly different. I would like to move the focus from banks to fintech. And I would like to ask you, what in your opinion would be, if any, would be the problems or the issues that those new fintech that are coming into the banking and financial markets will face in measuring, on assessing, on addressing the classical financial risks. So, the reason why I'm asking this question is that the banks have been managing the risk for the last centuries, because that was the core of their business, and they are still struggling. And now there are new players coming in, entering into the banking business, and so they very likely will face the same risks that banks are facing. So, will be a pessimist assumption saying that they may struggle in addressing or measuring in understanding the financial risk?
Thank you. I like this question. Before you answer, I like this question because I own a fintech company. So I would love to hear the answer. Go ahead.
It's a really good question. Virtual banks aside, I don't think there is a fintech company at the moment, and I may be wrong, that offers, going back to the slide that was shown earlier, that offers a full holding value, moving money, doing credit. It's not quite like a typical bank at this moment in time. The closer fintech companies go to being like a typical bank with a banking license, regulators will get more and more alarmed. And I think, for me, if you see this, the more fintech moves to being like a traditional bank, the regulation is what's going to kill it, because regulation is actually what strangles normal banks. So if fintech can keep itself out of that full banking regulation, so it doesn't fall under Sector 1 guidelines here in Malaysia, great. Falls under Sector 4, still there with e-wallets and e-money and all this. But as soon as it comes into full deposit-taking bank license, it's a challenge.
We are at 4 p.m. We did start a bit late. So would you like to continue a few more minutes? Well, there's someone who wants to ask the question. If everyone... Well, I'm going to use my moderating power and say, yes, we'll take this last question, and then we'll close the session.
It's more... Hello, I'm Sharifa from SME Corp. It's more actually a request for the panel to actually inspire the bankers in the room. Because at SME Bank, we actually administer incentives for bank to lend to SMEs. And over the years, we actually observed some who really take up the incentives. And those who work closely with us actually achieve a very high disbursement, approval disbursement, and achieve 0 NPL. We have it on, we have the data to prove that. But majority actually fail to even use the incentive as sweetener for their product. Again, claiming, SMEs, they are high risk, and then the moment the oil price fluctuate, don't lend to the oil and gas related businesses. Whereas you should actually support them because they have the agility to be very innovative and help the economy bounce back. But a lot of the bankers, I don't know, sometimes they're very risk averse. But so since you specialize in risk, can you in a way inspire them to actually take up the challenge, not to be so risk averse? Thank you.
Well, I will ask the two advisors on risk to answer that question.
Yeah, I don't think so there's right or wrong answer to this, because bank taking up risk is basing on their risk appetite. Right? Unfortunately, if the risk appetite or the SME is beyond their risk appetite, typically they will not accept the customers. I understand this point very clearly because I have quite a few SME friends who told me that, to get lending from banks, they just say don't bother. And I'm talking about credible, because of my friends. I'm talking about credible people that has been in the business for, he's the second generation, right? Imagine the second generation cannot prove that they are credible. I'm not too sure how to prove that, the credibility. Now, for them, is rather difficult in many angles. So first is like, if we're talking about fishing industry. So fishing industry, if you want to borrow to build a vessel, I think it's almost quite impossible, because unless you build a steel vessel, as I was told. Otherwise, you will not get insurance, and therefore you will not get a loan. So that's one thing. And second is, even if you could get a loan, the interest is rather crazy, because the LGD for a vessel is almost down to 0. I wouldn't say zero, but it's very, very minimal. And therefore, if a bank assess from a default perspective, you do not have enough information for them. Your book, if you are sole proprietor, almost no one believes what was in the book. Now, from a loss given default perspective, your vessel worth nothing, even though it's new. Right. So from that angle, I think it's rather difficult for traditional bank with a very tight risk appetite to accept those kind of credits.
So how would you, based on the question, how would you inspire this bank to change their approach?
I think to me, coming back to the unbanked topic that I touched on earlier. Now, to understand this SME, to understand their business is really about data, right? If we do not have data, then no way that the bank can model, and therefore, just a single out reject. Now, where do we get the data? Right? I think that's the first question that is more importantly. It's not like the bank do not want to get the data, but where and what data are they supposed to collect? And unstructured data, is it at this stage credible enough? So, for example, the social media information, are they credible enough? Yet to be tested. I think, therefore, I don't think the bank is not looking at it. I think it's just progressively at this stage taking a very moderate step at a time.
All right, thank you. Michael, quick one.
I'll answer it very, very quickly. If you can persuade the regulator that it's not going to fine a institution, so SME, it's not going to fine them huge amounts for breaching AML, etc., 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 then you will get a softening of risk appetite, and therefore it won't be an issue. The challenge here is that everybody is walking around on eggshells because they are concerned that they will be the recipient of a large regulatory fine. And that is dictating risk appetite at this moment. It is a point where if Industrial Revolution 4.0 can help you understand your customers and the behaviour better, therefore manage those other risks, not the financial ones, but the AML and the regulatory risks, then you have a better chance of onboarding them.
Thank you very much. I think a good friend mentioned that regulation is like salt. Sufficient salt, the food is nice. Too much salt, the food is not nice. So if you have too much regulation, SME will die. Right? So at the end of the day, I guess we probably need to inspire the banks through inspiring the regulators to give a little bit more leeway for SME financing. With that, ladies and gentlemen, thank you very much for being a good sport and participating in the discussion. Please join me in thanking the panelists for a good discussion.